Stop everything you're doing right now. What I'm about to reveal will completely change how you understand silver and gold. A major market analyst has just issued a warning that almost nobody is paying attention to. While most people celebrate recent gains, an enormous shift is taking place beneath the surface. Silver is flashing a signal that has appeared only 3 times in the last 70 years. Each time it occurred, the results shocked the financial world. Gold holders are particularly unprepared for what is coming next. If you ignore this alert, you will watch from the sidelines as one of the largest wealth transfers in precious metals history unfolds right before your eyes. The setup is complete. The trigger has already been pulled. Most people will realize the significance too late. Do not let that be you. Watch every second until the end, because missing even a moment could cost you dearly. Before we begin, tell me where you're watching from. Comment your city and state below. Let us start. I want to make it very clear from the beginning. This video is for educational and informational purposes only. This is not financial advice. I'm not telling you to buy or sell anything. I'm sharing observations based on publicly available data, historical patterns, and expert technical analysis. Always conduct your own research and consult a licensed financial advisor before making any investment decisions. Now let us get into what is actually happening. Silver is not just a metal. It is money. It is an industrial fuel. It is a strategic resource. Because of this, silver behaves very differently from gold. Gold is defensive. Gold moves steadily in predictable waves. Silver is reactive. Silver can remain quiet for months, even years, then suddenly explode with a force that catches almost everyone off guard. Right now, we are in that quiet phase. But beneath the surface, pressure is building like never before. A respected market analyst recently sat down for an interview that sent shockwaves through the precious metals community. His analysis was not typical market commentary. It was backed by decades of pattern recognition and technical expertise. He opened with a statement that made serious investors stop everything and pay attention. The gold to silver ratio is entering the contagion stage of its correction. For those unfamiliar, this ratio measures how many ounces of silver it takes to buy 1 ounce of gold. According to this expert, something massive is about to unfold. The technical charts are showing a story that most traders are completely missing. There is a critical level. The number is 65. This is not just a random number. It represents the neckline of a massive head and shoulders pattern that has been forming over multiple years on the macro time frame. The pattern is not perfect, but it is definitely a pattern. And that pattern just broke down. The ratio had climbed as high as 126. That is an extreme level. It shows silver was drastically undervalued compared to gold. Now the breakdown is happening in real time as we speak. The analysis suggests something remarkable. The ratio could collapse all the way down to the low 30s, but even that is not the end of the story. It could overshoot and potentially drop into single digits. Let that sink in. Single digits. Imagine a world where 1 ounce of gold only buys 8 or 9 ounces of silver instead of the 80 plus ounces today. The implications are staggering. Now here's the question everyone is asking. Is it too late to buy silver right now? The answer may surprise you. If silver is heading much higher, does the current price really seem like too much? You will wish you had bought more at these levels. This is not about short-term price targets. This is about something far more explosive, something called the law of the parabola. In exponential moves, most of the money is made in the final stages, the last 5 to 10% of the cycle. That is where 50% of the total profits appear. Most people sell far too early. They take small gains and feel smart. Then they watch in disbelief as the real move happens without them. Markets do not move in straight lines. They overreact in the opposite direction. When silver finally breaks out, everyone will suddenly think it is the best asset in the world. They will react emotionally and excessively. This is not hype. It is historical pattern recognition. The expert admitted he will sell at some point. There will be a cost to exit. But he also said something very unusual. He is not even sure what the dollar will mean at that point. Will it still be the same dollar? A digital dollar? Something completely different? The uncertainty around the currency adds another entire layer to this situation. Measured in the dollars we understand today, the belief is that silver will reach levels that most people think are impossible. This expectation is rooted in serious technical analysis and decades of observing market cycles. The contagion phase means technical signals start reinforcing each other. The move feeds on itself. Fear of missing out takes over. Rational valuations are thrown out the window. Charts dating back to the 1950s show how volatility compression works. When markets squeeze sideways for long periods, they store energy. When that energy is finally released, markets do not just move, they explode violently. The break below 65 on the gold to silver ratio triggered a macro reversal structure. It points toward the low 30s with significant room for overshoot. This is not a gentle correction. It is the beginning of a violent reversion to historical norms. Silver is not going to outperform gold slowly over time. It is going to do it in a parabolic fashion, catching most investors completely off guard. The stage is set. The pattern is confirmed. The move has already started. Now we need to examine something almost every analyst is completely overlooking: the supply side of silver. While most people focus on charts, technical patterns, or price targets, the real story lies deep underground. Or more accurately, it is not being mined at all. Here's a statistic that should shock you. 60 to 70% of all silver production is actually a byproduct of mining other metals. Let that sink in. The majority of silver in the world is not even being mined for silver itself. It is an accident of mining. Companies dig for copper, zinc, lead, or gold, and silver comes along as a side effect. This is critical. When silver prices rise, production does not automatically increase. Miners are not chasing silver. They are chasing the primary metal. Silver is just a passenger. Only 30 to 40% of global silver supply comes from dedicated silver miners whose primary goal is extracting silver from the ground. That is the minority. This creates a fundamental problem. Supply cannot react to price signals in the way normal commodities do. Higher prices alone will not generate significantly more silver in the short term. Traditional economics teaches that when prices rise, supply increases to meet demand. But silver does not behave that way. Byproduct miners are focused on other metals. They extract silver only if it is convenient. They cannot plan production around silver itself. It is purely accidental. They will find it if they find it. They will not if they do not. And even dedicated silver mines face challenges. Many have been shut down or mothballed over the years. They were considered uneconomical at suppressed prices. Rich veins of silver exist, high-quality ore bodies completely untapped. But at artificially low prices, it costs too much energy to extract them. Opening new mines, building infrastructure, and bringing production online takes years. The market is preparing for a supply squeeze unlike anything in modern history. The consequences are huge. Now let us shift to the demand side. This is where the story becomes truly explosive. The world is moving toward electrification, whether people like it or not. Electric vehicles, smart grids, renewable energy, the so-called green transition. Every one of these technologies consumes massive amounts of silver. Let me give you a concrete example. Solid-state batteries. These batteries can power electric cars for 900 kilometers on a single charge and recharge to 80% capacity in only 8 minutes. Revolutionary technology. But these batteries require enormous quantities of silver. If even 20% of new vehicles adopt these batteries, it would consume 100% of the silver produced globally. 100%. Just for batteries alone. No silver would be left for solar panels, nothing for electronics, nothing for industrial applications, nothing for medical equipment, nothing for defense systems. Everything planned in the technological future consumes silver at a rate that supply cannot keep up with. Solar panels, smart grid infrastructure, weapon systems, medical devices, and electronics all need silver. This is not a small problem. It is a perfect storm. Supply is largely inelastic. Demand is about to explode exponentially. The stage is set for a crisis that almost nobody is prepared for. Most investors are completely blind to what is coming. While the mainstream is focused on price swings or short-term charts, the real forces are structural. The global silver market could face an unprecedented deficit. Prices could soar far beyond conventional expectations. Now consider this. If solid-state batteries, solar panels, and EV production continue as planned, every ounce of silver currently produced may be consumed by demand in a single year. There would be nothing left for any other use. The industrial, technological, and defense sectors would compete for scarce supply. And this is only the beginning. Future technological advancements, government mandates, and renewable energy adoption will add even more pressure on silver demand. The current physical supply of silver cannot adjust fast enough. This creates a scenario where even modest price increases could trigger violent moves. Silver is poised for a parabolic surge. The combination of limited supply from byproduct mining and exponentially growing demand for technology and green energy is a rare market setup. It is a perfect alignment that has historically produced massive generational profits. Investors who understand this setup will see opportunities others do not even know exist. Those who remain unaware could be left behind entirely. The structural deficit combined with explosive demand is the hidden force that will drive silver prices far beyond conventional forecasts. This is not a warning for tomorrow. The setup is already in motion. The supply constraints are real. The demand surge is imminent. The markets are quietly compressing energy that will release violently. Silver is entering a phase few living investors have witnessed. A phase where scarcity meets technological necessity, and price moves are no longer gradual. They are explosive. They are life-changing. Most people will watch from the sidelines, thinking they missed the opportunity, while those who understand the structural forces at work could benefit immensely. Now, let us move to the tactical side of this market move. This is where professional traders separate themselves from the rest of the crowd. Understanding the fundamentals is one thing. Knowing how to position yourself to take advantage of it is entirely another. There are real ways to maximize a move like this. This is not theory anymore. This is about actual entry points, risk management, and real positions with real money on the line. A seasoned analyst recently revealed the trading approach he personally uses. He showed his actual trading platform, the one where he places real trades with his own capital, not hypothetical examples, not educational simulations, real positions, real stakes, real outcomes. The first challenge every investor faces right now is timing. The monthly chart of silver shows a relentless upward trend. No pullbacks, no clear entry points, just straight upward movement. Many people assume that buying now means chasing the top. They think the train has left the station. They believe there are no more opportunities. And if you only look at a single time frame, they are correct. But professionals use multiple time frames to gain a clearer perspective. While the macro view shows continuous upward momentum, shorter time frames reveal corrections, volatility, and genuine opportunities. Zoom into the daily chart, and what looked like an unbroken rally transforms into a series of waves. Corrections, consolidations, and retracements create entry points. This is the secret. Multiple time frames allow you to enter in stages, continuously improving your position without chasing price. During a recent pullback, while the mainstream declared that gold, silver, and Bitcoin had all topped out, patient traders found the chance to re-enter. The market itself provided multiple opportunities. Entries were not random. Stops were clearly defined at logical technical levels, not arbitrary numbers pulled from thin air. The method involves relative lows, points where the market structure would be invalidated if breached, and high-volume flushes, moments when weak hands panic and forced liquidation occurs. This approach works exceptionally well in parabolic moves. Those stop-loss levels, carefully placed during pullbacks, become trailing stops once the rally resumes. Positions that seemed risky when everyone else panicked became deep in the money. Gains of 150% and even 300% were already realized, with room to go higher. This is systematic planning, not luck. This is how professional traders protect capital while maximizing profit. Now consider the long-term perspective. Looking at the quarterly silver chart all the way back to the 1950s, we can see decades of compression, periods when silver moved sideways for years. Volatility dies down, traders lose interest, capital flows elsewhere. But these long squeezes store enormous energy for future explosive moves. The current setup shows a squeeze within a squeeze, and the compression inside compression, like a tightly coiled spring being wound ever tighter. When it breaks, the energy will be released violently. The breakout level is clear, the stop-loss levels are precise, and the first major target is $333 per ounce. But this is not the final peak. This is a resting place, a chance to take partial profits, lock gains, and reduce risk. Professional traders typically close about 50% of their position at such targets while letting the remainder ride for the next explosive phase. Now let us examine historical context. The gold to silver ratio chart provides shocking insight when viewed over decades. Current extreme readings, which seem dramatic today, are actually products of financialization. They are not natural market dynamics. Over decades, manipulation, suppression, and derivative layering have distorted the true market. Paper silver replaced real metal, inventory was artificially dumped to suppress prices, and above-ground stockpiles kept the market under control. But that is changing. Physical silver is being consumed. Above-ground inventory is no longer sufficient to suppress prices. When the ratio reverts toward historical norms, the resulting price moves will be sudden, violent, and unavoidable. This is why multiple time frame analysis is critical. By combining historical context with short-term volatility and long-term trends, investors gain a tactical edge. Entry points, stop-loss levels, and staged positions are no longer guesses. They are structured strategies rooted in history, patterns, and market behavior. Professional traders understand that the market provides gifts during pullbacks. Each retracement, every temporary pause in the rally, is an opportunity to strengthen positions. Most retail investors panic and sell, missing these opportunities entirely. Silver is not behaving like a conventional commodity. The combination of structural supply limits, explosive demand from technology and green energy, and the reversion of financialized ratios sets the stage for a parabolic move that few have seen before. Investors who master tactical entry points, manage risk systematically, and use multiple time frames are the ones who will profit most from this historic shift. The window is open now. Opportunities exist at every pullback. The market itself is giving patient and disciplined traders multiple chances to participate. Now we come to the most critical question. The question that will either create generational wealth or result in massive regret. When should someone sell their silver? This is the moment that separates those who capture the full move from those who sell too early. And the answer is not what most people expect. The exit point is not determined by a price target. It is not determined by a calendar date. It is not determined by a gut feeling. It is determined entirely by the gold to silver ratio, the ancient relationship between two metals that have been linked for thousands of years. Silver has never been about its standalone price. Its true value is measured relative to gold. And that ratio has been artificially stretched and manipulated for decades. Paper promises replaced real metal, derivatives stacked upon derivatives, and the true supply-demand dynamics were buried under layers of financial engineering. Now that correction is underway. Many people do not understand what is happening. The ratio compression visible on quarterly charts is not just a technical pattern. It is existential. This 70-year squeeze has stored energy like a dam holding back an ocean. When the dam breaks, the water does not trickle out slowly. It floods violently. Prices do not move gradually. They explode. The structural break has already been confirmed. The move toward the low 30s on the ratio has begun. But even that is not the end. Historical patterns show overshoot. Emotional extremes drive the market past fair value. Prices go beyond what appears rational. They blow past it completely before settling. The fundamental backdrop makes overshoot almost inevitable. Let us revisit the supply situation now that the full picture is clear. Only 30 to 40% of global silver production comes from dedicated silver mining. The rest is accidental byproduct. This means supply is fundamentally inelastic. It cannot respond to rising prices the way most commodities do. Meanwhile, demand is about to go parabolic. The solid-state battery revolution alone, if even a fraction of planned electric vehicles adopt this technology, could consume 100% of current global silver production. 100% just for batteries. Nothing would remain for solar panels, electronics, smart grids, defense systems, or industrial applications. Every part of modern life that requires silver would face shortages. The market is only beginning to wake up to this reality. Now we return to the law of the parabola. This is where most investors fail themselves. The exponential phase, the final stage, the part that looks insane from the outside. This is where most of the profit is made. Historically, 50% of total gains occur in the final 5 to 10% of the cycle. Most people sell early. They take profits at $100 thinking they are smart. Then they watch it run to $200. They sell at $200 feeling accomplished, only to watch it explode to $500. They convince themselves that $333 is the logical top. They exit prematurely and miss the overshoot, which could reach $1,000, $1,500, $2,000, or whatever the extreme conditions dictate. Markets overreact in the opposite direction during these phases. When the crowd finally believes, when silver is universally recognized as a top-performing asset, when fear of missing out overwhelms rational thinking, that is when prices detach completely from fundamentals. That is the exact moment to consider exiting. Even seasoned analysts admit uncertainty. Nobody knows what the dollar will be worth at that point. It may be a digital dollar. It may be something entirely different. The currency itself could be in flux. Yet, measured in today's dollars, the conviction is clear. Silver will reach levels that seem impossible now. Here is the final insight that ties everything together. The market wants to give you gifts. It rewards disciplined, patient traders. The pullbacks, the volatility, the moments when everyone panics, these are not threats. They are opportunities. The market is offering repeated chances to participate, to strengthen positions, to compound gains. But these gifts go only to those who understand multiple time frame analysis, manage risk meticulously, and resist panic when the uninformed crowd exits. Silver is not simply going higher. It is entering a phase that most traders alive today have never witnessed. Decades of suppression are reversing violently. Supply constraints collide with explosive demand. The gold to silver ratio is returning to levels that seem impossible until they actually happen. The contagion phase has begun. Technical patterns are confirmed. Fundamental factors are aligned. The only question left is whether you will have the courage to hold, the discipline to manage risk, and the vision to recognize the gifts the market offers. This move is generational. It will not wait for anyone. The train is already leaving the station. The final destination is far beyond what most people dare to imagine. All the analysis has been laid out. Patterns have been revealed. Now it is up to each individual to decide, will you be among the few who capture the full move? Or will you become another cautionary tale? Another investor who sold too early? Another story of what could have been. The charts are clear. The fundamentals are undeniable. If you found this information valuable, comment below. Share where you are watching from. Stay informed, stay disciplined. Most importantly, stay patient through the volatility ahead. Thank you for watching.